Hey, what's going on, everyone? It's Sal Bossio with Mortgage Universe, where real deals get done. So today I wanted to talk about one of the most powerful tools for real estate investors out there. It's called a DSCR loan. DSCR stands for Debt Service Coverage Ratio. Now, basically, it's just a way for lenders to measure whether the rental income of a property will cover the mortgage. So, for example, if the rental income on a home is $2,000 a month, we want to make sure that that mortgage payment, principal, interest, taxes, insurance, and if there's HOA as well, we want to make sure that that full payment is $2,000 or under. And that's essentially how you get approved. We don't, the crazy thing, the awesome thing about these loans, and the reason why I love them so much is because it doesn't require you to have any income at all. You don't even need a job. No pay stubs, no W-2s, no taxes, no bank statements. I don't have to run a digital underwriter. I don't have to run AUS approval to get an approved eligible or I don't have to worry about any of that. And neither do you. So it's a very stress-free process. And then of course, we'll send an appraiser out to do what's called a 1007 to basically figure out what the average market rent is in the area and how your home actually fits into the picture, right? So we can't say a home that is bringing in $2,000 a month is bringing in $3,000 a month. However, there are different types of ways that we can go about getting these approved, whether it's approved as a long-term rental, whether it's approved as a short-term rental like an Airbnb or Verbo. A long-term rental would be more like, signing a 12-month lease or having a tenant sign a 12-month lease. But there are just different ways that you can go about these types of loans. So it's the type of thing where you have a conversation with your loan officer, you pick out a home, you guys talk about it, you figure out if, the estimated taxes, what are the estimated insurance, what's the, is there HOA on it, and we figure out generally, will the property ratio? And if it does, well then great, you can submit it. Typically with these loans, you want to put 20% down. That's usually the minimum, although there are several lenders that will accept 15% down. You're not going to want those loans though, to be honest. I have tons of lenders that do them, but the rates are much higher, usually 1% or 2% higher. With these types of loans, I do have lenders that go down as low as a 620 credit score, but you really want to be a 680 or above for these types of loans. You just get much better terms. 700 really gets you way better terms. But yeah, 20% down is usually what I tell everyone as far as minimum amount down for these loans. The more you put down, the better it's going to ratio, because the more you put down, the lower your mortgage is going to be, because the lower the loan balance is, right? With these types of loans, I mean, again, like you don't have to be an experienced investor. You don't have to own, there's a myth that you have to own at least one rental property before you can do a DSCR loan. Not true at all. I have plenty of lenders that will allow us to do DSCR loans even if you've never owned a rental property. Sometimes these lenders count your primary residence. If you've owned it for at least 12 months, they will count that as experience owning a home. So as long as you don't always have to even own a property. I've done DSCR loans for borrowers who are living rent-free with their parents or living rent-free with a friend or whatever, and we're still able to get them an investment home and start building their real estate portfolio.